You know when you hear a term, like all the time in finance, like VWAP, and you sort of nod along, but you're thinking, what exactly is that again?
Yeah, volume-weighted average price. It sounds a bit technical.
Right. But today, we're going to unpack it. The core idea is actually pretty useful, I think.
It really is. VWAP, it gives you a different perspective, doesn't it? Because it brings volume into the average price.
Exactly. It's not just price. So think of this as your quick guide to understanding VWAP. We looked at this YouTube tutorial by Apishek Kar,
Yeah, it was a free one.
and our mission here is just to pull out the key stuff, the practical bits you can actually use, without getting lost in the weeds.
Mm-hmm. And that tutorial, it seemed aimed at pretty much everyone, from beginners to maybe algo traders. It even suggested you could, build strategies from it.
Ambitious?
A little, maybe. But we're filtering it down, focusing on what seems most immediately valuable.
Okay, so here's the plan. We'll look at where VWAP actually applies. You mentioned indices versus futures. That's a big one.
Yeah.
Then, how it's not just a simple moving average. What's the real difference?
Crucial distinction.
We'll cover the best time frames for using it. Seems it's mostly an intraday thing.
Pretty much, yeah.
Then the classic interpretation, above is bullish, below is bearish, but with a catch.
Oh, a big catch. The trend.
Right, the overall market trend, how that changes everything. Plus, using VWAP with gaps and the whole 1 minute versus 5 minute chart debate.
Lots to cover. Should be good.
Ready?
Let's dive in. So, first things first. Where can you even use VWAP?
Right. Okay, fundamental point number 1. It needs volume data.
Seems obvious from the name, right? Volume weighted.
Huh, yeah. But it means you can't just put it on any chart.
Exactly. You can't just apply it directly to, say, the Nifty index chart or Bank Nifty, Fin Nifty,
Yeah.
the main index charts themselves.
Why not?
Well, simply because those index charts, they don't track volume directly. An index is just a calculation, like an average price of its stocks.
Okay. It's not a thing being bought and sold itself, so no volume count for the index per se?
Precisely. So if you try adding VWAP to a plain Nifty index chart, it might look weird or just not work properly.
Got it. So where do you use it for indices then?
That's where the futures contracts come in. Nifty futures, Bank Nifty futures. Those are traded instruments.
Okay.
They have their own volume data. So you apply VWAP to the futures chart if you want to analyze the index's price action with volume context.
Makes sense. So rule 1, find the volume. Futures, stocks, things that actually trade.
That's the core principle, yeah.
Okay, next point. VWAP versus a simple moving average. They can look kind of similar on a chart sometimes, right? A line tracking the price.
They can, visually. Yeah. And both give you a sort of average price.
Yeah.
But what they average is completely different.
How so?
A simple moving average, well, it just averages the closing prices over, say, the last 20 periods, just price.
Okay.
VWAP, though, it looks at the price and how much volume was traded at each price point during the day. It weights the average price by the volume.
So price points where more trading happened have a bigger impact on the VWAP line.
Exactly. That's the key. It tells you the average price where the bulk of the trading, the real money, has been moving during that session.
Why does that matter more than just a simple price average?
Well, volume often indicates conviction, right?
Yeah.
A move on high volume is generally seen as more significant than one on low volume. So VWAP gives you a benchmark price that reflects where the real market activity occurred. It's often seen as a fairer representation of the average price paid during the day than a simple moving average.
Okay, that distinction is clear now. It's the volume weighting. Now, about time frames. When is VWAP actually useful?
Right. The source material is pretty direct about this. VWAP is mainly an intraday tool.
Meaning for trades within the same day?
Yeah, not really for positional trading, holding for weeks, or even swing trading over several days.
And why not? What happens if you put it on like a daily chart?
The tutorial showed this on a daily chart. The VWAP line tends to just hug the price action really closely.
So it smooths out too much.
Yeah, it becomes almost indistinguishable from the price itself, making it really hard to get any clear trading signals from it. It loses its edge.
Okay, so daily charts are out for VWAP. What are the good intraday time frames then?
The tutorial mentioned specifically 1 minute, 3 minutes, 5 minutes, and 10 minutes. Those seem to be the sweet spots.
Interesting that it stops at 10 minutes. What about, say, a 15-minute chart? Still intraday.
Good question. The tutorial kind of hinted that on slightly longer intraday charts, like 15 minutes, you might lose some nuance.
How so?
Well, a single 15-minute candle bundles a lot of activity. A quick spike in reversal near VWAP might get smoothed out within that single candle.
Ah, okay. So the signal might be gone or less clear by the time the candle closes.
Potentially, yeah. So the focus is really on those shorter 1 to 10 minute frames for clearer VWAP interaction.
Right. So we know where to use it and when. Now, how do people typically interpret it? The basic idea.
The standard sort of textbook interpretation is price trading above the VWAP line suggests bullish sentiment for the day.
Okay. Buyers are in control, paying above the average weighted price.
Exactly. And conversely, price trading below VWAP suggests bearish sentiment. Sellers are pushing the price below that average weighted level.
Seems simple enough. Above is good, below is bad. But you mentioned a catch earlier.
A huge one. The tutorial really hammered this point home. Just blindly trading based on whether the price crosses above or below VWAP. That's risky.
Why? What did the examples show?
They showed scenarios where the price dipped below VWAP for a bit, looked bearish, only to rip higher straight afterwards. Or it popped above VWAP, looked bullish, and then just fell back down.
So those simple crossovers aren't reliable on their own?
Not at all. You can get chopped up pretty badly, relying just on that.
So what's the missing piece? What makes it work?
The broader market trend. This was like the core message. You have to consider the overall direction of the market, the main indices.
How do you determine that? The tutorial mentioned higher highs?
Yeah, using basic price action, looking at maybe hourly or even 15-minute charts of the main index, like Nifty. Is it consistently making higher highs and higher lows?
So identifying a clear uptrend or downtrend first.
Absolutely. If the market is clearly trending upwards, making those higher highs, the tutorial suggested that taking a short trade just because price momentarily dips below VWAP is probably a bad idea.
Because you're fighting the main current.
Exactly. Those dips below VWAP in a strong uptrend are more likely to be buying opportunities before the price resumes its climb. Countertrend trades based only on VWAP are generally lower probability.
So align the VWAP signal with the bigger picture trend identified through price action. Higher highs, higher lows for longs.
Right, and the tutorial gave that Nifty example, consistently making higher highs, suggesting you should favor long trades on pullbacks to VWAP.
Did it mention other ways to gauge the trend, maybe on longer time frames?
It did, yeah. It touched on what it called more hardcore price action, like looking at a daily chart and seeing if a major resistance level, say 17,800 in their example, has recently been broken and is now acting as support.
Ah, resistance turning into support. A classic sign of strength.
Right. So if you see that kind of confirmation on a higher time frame, it gives you much more confidence that the overall trend is bullish, making those intraday long signals off VWAP more reliable.
Okay, context is king, basically. Trend first, then VWAP signal. Got it. Now, there was a specific hack mentioned about gaps.
Yes, the gap scenario. Specifically, trading a gap up when the overall market trend is actually down.
Okay, interesting setup. What's the play?
So market's generally weak, but it gaps up significantly one morning. If on that same day the price starts trading below VWAP and maybe forms 2 or 3 candles below it, that could be a good shorting opportunity, according to the source.
What's the logic there?
The idea is the gap up might just be a temporary blip, maybe short covering, in a larger downtrend, if the price can't even hold above the day's volume-weighted average price.
It suggests the sellers are taking back control quickly.
Exactly. It hints that the gap up wasn't sustainable and the underlying downtrend is likely to resume.
That's a neat, specific setup to look out for. Okay, let's shift gears to the time frame debate again, 1 minute versus 5-minute or 10-minute charts.
Right. The tutorial had a definite opinion on this. It suggested the 1-minute time frame. Well, it can be tricky.
Tricky how?
More prone to whipsaws. Those sudden, quick moves back and forth that don't really go anywhere but can easily trigger your stop loss.
Noise. Lots of false signals.
Pretty much. The tutorial framed the 1-minute chart as being more suitable for like really experienced scalpers, people who are nimble and aiming for tiny profits and know how to handle that noise.
So maybe not ideal for someone just starting with VWAP or trading in general.
Probably not, based on that advice. Too easy to get faked out or stopped out repeatedly.
So how do the 5-minute or 10-minute charts compare?
The idea is that because each candle represents more time, there's more averaging going on, it helps filter out some of that micro noise. A bit smoother, yeah. Fewer false signals, potentially. The source suggested you're less likely to make errors based on those very short-term, insignificant fluctuations.
Did they give an example of this difference in action?
They did. They talked about a gap down scenario. On the 5-minute chart, The example showed the price gapping down and then just staying below VWAP for the rest of the day. Never really retested it.
Okay, a clear, sustained move down relative to VWAP.
Right. But the point was, on a 1-minute chart during that same day, you might have seen price flicker above and below VWAP several times.
Giving conflicting signals if you were only watching the 1 minute.
Exactly.
Okay.
While the 5-minute chart gave a clearer picture of the dominant bearish sentiment for that session, at least in that specific example.
That really highlights how time frame choice affects the signals you see. It needs to fit your style and tolerance for noise.
Absolutely.
Okay, wow, we've covered a lot. From what VWAP is, where it applies,
The volume difference in moving averages.
the importance of intraday timeframes, the critical role of the broader trend.
That gap strategy, and the 1-minute versus 5-minute considerations.
Seems like the key takeaways are VWAP needs volume, so think futures or stocks. It's different from a simple average because of that volume weighting.
Right. And it's an intraday tool, mostly 1 to 10-minute charts.
Critically, don't trade it in isolation. Always, always check the broader market trend first.
That's probably the biggest one, trend alignment.
And be mindful that super short time frames, like 1 minute, can have more noise. So VWAP is useful, but definitely not magic. Needs context.
Precisely. It's a valuable tool in the toolbox.
Yeah.
You need to understand how and when to use it effectively, combining it with that broader market picture.
Absolutely. So here's a final thought to chew on. Even if you don't end up using the VWAP indicator directly on your charts, how might just understanding this concept, the idea of a volume-weighted average price, change how you look at market action?
Interesting question.
Like just being aware of where the heavy volume is trading during the day, where the market is accepting price based on activity, could that give you insights, regardless of your specific strategy?
That's a really good point, thinking about where the market energy is concentrated volume-wise. Yeah, that could definitely add another layer to analysis, even without the specific line on the chart. Food for thought.
Definitely. And if this has piqued your interest, keep exploring. Technical analysis is deep. There are always more ways to combine tools, look at price action.
The learning never really stops in trading, does it? This is just one piece, but hopefully a useful one.